QYLD ETF at one time was all the hype in the dividend/income investing community. This is because early on it seemed to promise steady, consistent returns from its sort of conservative covered call strategy, with also distributing massive dividends to cash-hungry investors like myself on a monthly basis. But over time, as the future would show, QYLD might not have been exactly all it was cracked up to be. Now in this video, we are going to do a deep dive into QYLD, explain how the ETF works, the good and the bad, and why I decided to invest so much into this ETF years ago. But before we dig into all this, make sure to please drop a quick like on this video and subscribe for more future content like this. So first off, heading over to the Global X website, looking at QYLD in all the information overview. It says reasons to consider QYLD. QYLD seeks to generate income through covered call writing strategy, which historically produces higher yields in periods of volatility. Now this is definitely true, and this is why I utilize covered calls across my dividend growth portfolio. It does reduce volatility because writing covered calls on underlying stocks can reduce the downside, but also unfortunately caps the upside, which is one of the issues I have with covered call funds like QYLD. Now also it says monthly distributions. QYLD has made monthly distributions for 9 years running, which it has and which we will go over in more detail later in this video. It also says efficient option execution. QYLD writes call options on the NASDAQ 100 index, saving investors the time and potential expense of doing so individually. Now, like I said earlier, the fund strategy is pretty simple. It writes at the money cover calls on a monthly basis on the NASDAQ 100 index, which in my opinion is a really high quality index, which has a ton of really high quality stocks made up in it. So as of so far, looking at some of the reasons to consider QYLD, it seems pretty bulletproof, and it seems like it would have pretty good performance, at least based off of all this. Now, another important aspect of QYLD is that it has an $8.1 billion of net assets, a 0.6% expense ratio, and the NAV is $17.50 as of right now. So just to rip the band-aid right off, going over some of the bad of QYLD, and one of the reasons, like I said a minute ago, on why I sort of dislike a lot of these covered call ETFs, although I do still own many of them. QYLD on the max time frame is down 32.08%. Now you can call this share decay, you can call it ETF erosion, you can call it whatever you want to call it. But the reality is that investors that bought into QYLD back in 2014 and paid around $25.50 per share would now in theory be sitting at a minus 32% return. Again, this is just share price. This is not dividends included, of course, which we will go through here in a second, and I'll show you all the details on that. But regardless, the point remains. With covered call funds, the upside is going to be capped, but the downside is not necessarily going to be capped. Now, what I mean by that, whether it's you or I or Global X selling a covered call, if the underlying was to rocket up in share price, let's say all these different holdings in here, things like Apple, Microsoft, Amazon, etc., everything that's made up in the NASDAQ 100, if they were to move up in price very, very fast, the covered call aspect of this fund is going to have a capped upside potential. But if during a certain time frame, the NASDAQ 100 moves down quickly, which historically there's been periods where this has definitely happened, the covered call ETF is going to have some downside protection because of the premium, of course, but still, depending on how far it goes down, it's most likely going to lose some value. Now, for me personally, this is the main reason on why I don't like or dislike these covered call ETFs, is because of that exact mechanism. But even with the ETF price erosion that some of these covered call or most of these covered call ETFs have, it doesn't mean that maybe the dividends won't make up for it. Which brings us into the dividend for QYLD, which the trailing 12-month dividend yield is actually pretty decent at 11.6%, the trailing 12-month payout at $2.03 per share. Now, looking at every single dividend that QYLD has paid historically, over time, the dividends have been all over the place. Some months being as low as 10 cents per share per month, and then some months being as high as over 20 cents, 25 cents per share per month. But as of recently, over the last year or so, they've been pretty consistent at around 16 to 18 cents, which once again isn't all that bad. It gives us around a 10 to 12% yield. Now, that being said, some of the covered call ETF fans always argue that even if there is some share price erosion, like we showed you a second ago, even if an ETF like QYLD is down over 30% as far as ETF price, the dividends are going to make up for it because these covered call ETFs do, in fact, which to be fair, they pay a lot higher dividends than the average stocks or ETFs out there. So the idea is that even if the ETF price loses some value, the dividends are going to make up for it and then some, which should give an investor hopefully a total return, which makes it much worthwhile to invest into. Now, the cool thing is that we can chart this out and figure this out exactly. So using the metric total return, which is the ETF share price return plus dividends included. So basically all this ETF has either returned or lost will be shown right here. So year to date, this ETF has actually performed very, very well, which I'm definitely thrilled about because I currently own around 2,000 shares, more or less, of QYLD, but I'll talk more about that a little bit later. This ETF has done really well year to date, up almost 19%, which is great. On the last year time frame, up almost 19% as well. But on the 3-year time frame, this ETF has definitely seen some of its weakness, up 14.32%. Which of course, if an investor was to have just bought into the QQQ, even without the massive dividends, they would be up 37, almost 38%, where QYLD, even though it pays out the nice shiny monthly payments on a monthly basis, it's only up around 14%. Now on the last 5-year time frame, it's sort of more the same. The Qs are up 115% almost, where QYLD is up 24%. And these are dividends included. Now what's also pretty cool is that if we were to chart out QYLD since inception in 2013 and chart it out next to the NASDAQ 100 index, over the last 13 years with $10,000 invested, for example, an investor buying into QYLD would have had at the end of this whole thing around $18,500 from their $10,000 initial investment, which means an investor would have made an average annual return of around 6.51%, a total return of 85.10%. Now this example is with dividends reinvested, keep in mind. So if an investor was to spend the QYLD dividends along the way, things would look much differently, which we'll go through here in a second. Now, if around 10 years ago, an investor was to forego the massive shiny dividends that something like QYLD offers and just bought into the NASDAQ 100, that $10,000 would in theory be around $48,410 at the end of the 10-year period, offering a 17.54% average annual total return. So it's pretty obvious that if an investor was to invest just in a NASDAQ versus investing into QYLD, they would be much, much better off. And to be honest, it's not even close. We're talking like 3 times more money when it's all said and done. Now, if an investor was to not reinvest the dividends in QYLD, they'd be left with around $15,500, and with the Qs around $46,000. So either way, no matter how you want to look at it, an investor buying into QYLD and holding on to it since inception with just $10,000 invested would have made some money, but not necessarily all that much. And to be honest, this is sort of the more dark side about some of these covered call ETFs. They promise investors with things like high income potential, nice monthly distributions, because who doesn't love getting paid out on a monthly basis, and also efficient option execution, which can, of course, in theory, help against downside or even volatility. But as we see, going through the actual numbers, charting out QYLD, and seeing the actual performance since inception, it's not necessarily the case. Now, I know you're probably wondering, well, I said earlier that I personally bought around 2,000 shares of QYLD a few years back, and I currently am down in the red on my trade. But with all the dividends that have been paid out over time, I'm probably pretty close to break even. Now, that being said, I'm not necessarily willing to sell off my QYLD as of right now, because I do think that this ETF does have some potential. At least it has done pretty well over the last year time frame. But just like any other stock or ETF, to be fair, it's going to matter on how the overall market or the underlying index that it tracks is going to perform over the next year or so, and that's really either going to make or break this ETF. But that being said, moving forward, I personally would never invest another dollar into QYLD. And although at times it's been tempting where it's down a lot in price, and maybe I'm thinking to myself, it's time to average down and grab some more shares of QYLD, but I just don't think that it's worth it at this time. Not to mention, I also think that there's better other covered call style ETFs out there. Something like JEPQ that has an underline that has more growth potential and still offers a nice juicy dividend yield. But when it comes to QYLD or other covered call ETFs for that matter, is this a type of investment that finds itself in your portfolio? And if so, which is your favorite covered call ETF of all of them? Comment down below. If you enjoyed this video, make sure to please drop a like in it and subscribe for more future content like this. Thanks as always for stopping by, and if you are interested in investing, make sure to check out these recent videos I posted right here.